Hello, everybody. Welcome back again. Welcome to the part 4 of the annual report analysis of Hero Motors. So, the last part we saw the income statement and the balance sheet, and we looked at it in detail. Now, let's look at the third one, that is the cash flow statement. The cash flow statement is really important because it actually gives an idea, like, is the company generating the cash as per what it's saying in the income statement. So people who don't know the basics of accounting, just to give you an idea, we the usually the like everywhere in the world, they follow the accrual method of accounting, where uh, let's say you say that you have a revenue of like 100 crores. That actually doesn't mean that you got the cash of 100 crores. That means you might have some receivable. That means you've sold something, but you've not received the cash. So when you look at the cash flow statement, it might actually look a little bit different. Sometimes it can look like totally different because of various other factors. And that actually throws some other red flags. That means is the company going to have cash? Because cash is the final thing why any company exists, right? So if a company goes out of cash, that means it's done, and it has to, you know, either resort to selling its assets. That means its future earning power will really go down, as it has happened to many, energy companies recently, or it might just go bankrupt. But over here, we are not looking at the cash flow statement from that angle because health-wise, Hero Motors seems to be pretty healthy. So here, what we are going to like focus is the different expense items that actually were not evident from the income statement. So let's look at the operating activities. So again, the cash flow statement is divided into three parts: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. So operating is like, all the operations. That means you sell the good and you pay for the expenses. So selling minus, like, you whatever revenue you get minus expenses, usually the cash generated from operation. Then investing is whatever money you spend towards your factories and your other things that actually create the assets based on which you run your business. That's called capital expenditures, and it also includes some expenses you go and you put on, like, let's say you acquire a company or you invest somewhere else. So those things are put there. And then the financing is like, if you take a loan or you repay it or you raise money through the public. So all those are through financing, and all the also the interest that you're paying. So obviously that's an Indian accounting system. The interest paid is shown in the cash flow from financing activities. So obviously you want to see a positive cash flow from operations. So here, if you look at it, so the profit they showed as 3,700 crores. Now they start adjusting. That means depreciation was a non-cash item. Then this tax expense that they showed there is a non-cash for the cash flow of operations, and all other things. So when they deducted these things, they actually came to 2,190 crores. Then they have to make a different, some other adjustments. And sorry, let's go back here. And when they do that, sorry, all these, I'm really sorry. So the addition of all these items is about 2,100. Then they have to subtract something. So they added all these because they were non-cash items. Then they subtracted. That means these were non-cash expenses. That means you have to sorry, these are non-cash revenue. So they have to subtract all this. That means the gains on investments and everything they made. So now 2,190 minus 579. When they do that and they add to 3,722, they get 5,300 crores. So before the working capital changes, the company generated 5,300 crores. Now obviously there is changes. That means the inventories If they increase, that means they have to put more money towards inventories. That goes away from cash flow, and vice versa. So when they do all these adjustments, they have to again take out 200, about 269 crores, and then uh, after doing all those things, and you take out the less income tax paid, about 4,000 crores was their cash flow from operations. Okay, now out of that, 820 crores they have to put back towards building new plants, upgrading them, and all those things. Okay, so if you look at that, so the main thing is their free cash flow. That means whatever they generated and whatever they had to spend towards the capital expenditure is about 4,000 minus about 3,200 crores. Now again, this can widely vary, and it can vary for different reasons, and that's where you have to see. So like in the previous year, the capital expenditure was 1,200 crores. That means they were making more investment. So here again, you have to dig in deep if each figure is changing. And overall, again, for your valuation, you have to figure out the average. That means in an average, how much they will be needing to spend towards capital expenditure to grow their business and overall uh, grow their cash flow from operations. So that's one thing. And then these are, some fixed deposit investments and those things. That's okay. They are like buying and selling. So that's not that much relevant here. That can be really relevant to a financial business like a bank or insurance company. That's a whole different topic. And then what we do is we look at the financing activity. So they did pay the dividend, that is the money they paid to the shareholders, which is pretty good. And they had like a very small interest here they are paying because they themselves literally carry almost zero debt. So very less debt they carry. So they paid about 31 crores in interest, and they had to pay some taxes on the dividends they distributed. So overall, the cash flow looks pretty healthy, and everything looks spot on. And there is no, you can say, you know, something. There is nothing that is which is really alarming. So now let's go back here again. So we looked at uh, the income statement, balance sheet, cash flow, then the three major these things. So now uh, let's look at the note 27. That is the breakup of revenues between two-wheelers and others, and the note 37, that is segment reporting, and note 38. I'll tell you why 38 is also important. Uh, so let's first look at 27. Going back here. So here it shows out of 32,000 crores, what is the breakup? So most of their this thing, they are getting from selling two-wheelers. They make like really small amount selling components and spare parts, which is uh, which is kind of somewhat relevant because if this again you have to do a relative comparison, if this is changing as per the sale of two-wheelers, the sale of spare parts, then it's okay. But let's say for some reason the percentage of spare parts to two-wheelers is changing, then it's like that means the rate of increase of spare part sales is not same as this, then might need to dig in further. But if you're looking at the difference, this is just 2,500 crores out of 33. I wouldn't say don't spend much time here. Now they do get they make some money out of dealer support services and some other programs, 200 crores, and they have some other revenue. That means duty drawback, incentives, and incentive on investment from state government. So whenever there's a anything a company makes from the government, I'm a little skeptical. So now if you do the math, so out of 33,000, 29,000 they actually make from selling two-wheelers. That means around 3,500 crores they're making from all different things, which is kind of almost 10%, you see, of this figure. So you might want to like kind of look at least the spare parts and the government incentives, like what are those things and what will be their future expectations. So those two things you might have to also consider when you're valuing. Now, Other than that, let's look at note 28, which says something about other income and see how relevant that is. Uh, so that is just the next note. So that's the other income. So they made about 523 crores. So here, profit on sale of investments. So this is again something which can really vary every year because it depends what was that investment and all. I wouldn't kind of factor into have a good factor of safety. Maybe you can just take a very low number for this, and same for this net gain and the interest they are earning. This is pretty okay because this will be pretty stable because they will have a good fixed deposit and they'll be earning good interest. So these two are okay, but the other points like profit and sale on investments and net gain, you might want to little bit be have a good factor of safety around these because these might not be the same every year. So you have to more look towards the lower range. Okay, so we looked at most of the footnotes. Now let's look at quickly into note 37 and 38. Okay, so here, what does that mean? Is So what we are trying to do here is, if we see the note 38, what we are uh, so let's go to that note 38 and let me see. So it is to do with the related party disclosures. Why this is important? If you think about it, uh, it's very simple. This company is controlled by the Muljal family, okay, and they also have interests in other companies that supply this, which is kind of there's no there is nothing wrong with that, but you just have to pay a little attention, why that is happening. That means look at this figure. So the Munjal company controlled these two companies, AG Industries and Rockman Industries, which supplied raw materials worth 2,800 crores, which is again one needs to a little bit. If this is like a really big number, that means the promoters have some other interests also, which is uh, kind of it can raise a little red flag, why people are doing this way. But overall, one just this is you don't have to factor in your valuation, but you just have to keep this in mind. This is because when you're trying to evaluate what is the management effectiveness and what is their intent, these things might also play a big part. Other than that, then the other main point here that we have to look around is it's what is the comparison of the charges that are expensed versus capitalized. So there is a R&D expense. So that is note number 41. So here, if you look around that, here the research and development is something that you can expense or you can capitalize also. So they expensed about 365 crores and they capitalize about 128 crores, which is good. This is a good. Usually, sometimes, if they're capitalizing more than what they're expensing, that means they're kind of their income statement is not actually accurate and you might have to look further. So these are the main things. So we kind of pretty much covered all the points, all the main points to do with analysis of the annual report. And in our the last part of the series, what we're going to do is we're going to again look back and see what is the conclusion, number one, and what exactly are the next steps that you will need to do in order to analyze and to finally come up with a fair value, right? I mean, that's the main objective, that why you are doing the analysis is to get the factor of safety and then figure out the fair value. So all that we're going to do, we're going to look at in the next part. So, I hope to see you in the